The S&P 500 is viewed as almost an unbeatable benchmark. The standard advice is to just invest in this index, and you're essentially tying your net worth to the growth and robustness of the US economy. And historically, at least so far, that has delivered really fantastic outcomes. And that's possibly why Warren Buffett famously says to never bet against America. But with that said, people, of course, are always looking for an index, a benchmark, a grouping of companies that could potentially give you better returns than the general S&P 500. And today I'm going to be highlighting two of these potential funds. They have very different methodologies, but there is some research that both of these could have alpha over the market over long periods of time. And I also want to spend some time talking about the actual economy, which is what all of these investments are based off of, because this week has been very interesting when it comes to the economic data that has been released. So I hope you guys enjoyed the video. If you do, a like, subscribe helps out a lot. And let's get right into this. So beginning with the economic data, we started the week with this really fantastic piece of news. The US economy grew at an annual rate of 2.4% in the second quarter. And it's another piece of data potentially indicating that all of these recession forecasts are premature. For context, on a chart over the past couple of years, this is what the historical change in GDP looks like. So we did have a technical recession, 2 back-to-back quarters of GDP contraction in the first half of 2022. But since then, the economy, against all expectations, has been strong. And the most recent reading of the second quarter of 2023 reiterates this with that growth rate of 2.4%. I will say that from here, the expectation is GDP growth will be lower. I mean, even the Fed thinks in their SEP that the economy will slow down in the coming quarters. But with this new incoming data, they might have to readjust their forecast. And to me, this is just another data point that nobody knows what's going to happen in the future. Nobody. So this surprising growth was driven by two main factors: consumer spending and business investment. And having growth from both of these sectors is a very healthy thing. Business investment is great for the long-term health of the economy, and current spending by consumers indicates confidence and disposable income. Now, this 2.4% annual growth rate is up from the 2% growth rate in the first 3 months of the year and is far stronger than forecasters expected just a few months ago. And the market reaction to this was a little bit counterintuitive. This is when the report came out. Initially, the market went up slightly, but then it ended pretty far in the red. And the reasoning behind this goes as following. If the market is stronger and more resilient than expected, the Fed might be forced or be able to raise rates higher than previously expected to fully tame inflation. So that caused people to readjust their expectations on the day slightly. But then just today, we got another piece of crucial inflation data that the Fed is pretty fond of. It's called PCE, and it came in at a nearly 2-year low. So inflation showed further signs of cooling in June. Core PCE rose 4.1% from a year ago compared to the estimate of 4.2. So that was the lowest rate since September of 2021 and marked a decrease from the previous pace of 4.6 back in May. And headline PCE inflation is even better, and it rose 3% on an annual basis. And this was the lowest since March of 2021 and down from 3.8% in May. And in reaction to this, the market then jumped back up about a full percentage point. Because together, this latest data, as well as all the previous data, it's indicating the Fed is succeeding in both taming inflation and not destroying the economy, aka that soft landing. Because ultimately what we want is strong economic growth with 2% sustainable inflation. And with this data, we have stronger than expected economic growth and inflation that's coming back down to normal levels. I will stress the fight against inflation isn't done yet, so there still is some anxiety around that. But so far, things are looking much better than anticipated this time 1 year ago. Okay, now pivoting to the investing side of all this, what is the best way to benefit from this strong economic growth? Most people recommend the S&P 500, and full disclaimer, I think the S&P 500 is an absolutely fantastic investment for most people, but I have two names here that might be on par, if not slightly better than the S&P 500. These names are MOAT and DIVB. And you can see that over this time period, which included a very strong bull market, a pullback, and the beginnings of a new bull market, both of these funds, MOAT and DIVB, are doing a fantastic job keeping pace, if not straight out outdoing the S&P 500 in this window of time. And if we change to a different view, like the past 5 years, the story is pretty similar. It does seem like MOAT might be the slightly better overall choice, especially recently here. So for DIVB, their strategy is to focus on US equities that produce dividends and share buybacks. Because there is some evidence that dividend paying companies, especially dividend growth companies, for whatever reason, whether it's that direct return of profits to the shareholder or the effects it has on management, whatever it is, these companies tend to have slightly better performance and reliable returns than the rest of the broader market. And same thing for companies that buy back their own shares. It helps to directly increase shareholder equity. As you would expect, there is a lot of overlap between the S&P and DIVB. So about half of DIVB's holdings are in the S&P 500. And right here are the main differences. So in comparison to SPY, DIVB has more allocation to these companies. And the returns of this strategy are very nice. Over a 5-year time span, there's times that it goes below the S&P, but also above the returns of the S&P. And then the other name here that has even better performance is ticker MOAT. And this is all about companies with sustainable competitive advantages. And specifically, these are the types of competitive advantages this ETF is looking for in its construction. So the advantage has to be long-term, 20 years or more. They're looking for network effects. This is when a product or service becomes more valuable as people use it. Intangible assets, this is things like patents, logos, brand names. Cost advantage, switching cost. So this is when it's difficult to stop using a particular service or product. And finally, efficient scale. So the ETF MOAT is a collection of companies that meet this criteria of a strong, lasting competitive advantage. And here is the results against the S&P. And I gotta say, it is extremely impressive, up 100% in the past 5 years, including reinvesting that dividend. I mean, that's almost as much as a dedicated growth ETF like SCHG. Yeah, over this time, SCHG only has 6% more returns with a ton more volatility. And for continuity, let's add DIVB back into the mix. So my opinion here is all of these funds are clearly very high quality, but they're all slightly different. And if for some reason the S&P isn't doing it for you, you might want to check out some of these other names. But that's it for now, and I'll see you guys in the next one.